Hey guys, welcome to another video. Today we're discussing solvency ratios, and these are balance sheet metrics that measure the company's ability to meet its long-term obligations. If you've seen my previous video on liquidity ratios, the difference between liquidity and solvency is that liquidity generally refers to short-term, so that's the ability of the company to meet its short-term obligations, versus solvency. Here today we're discussing these three metrics or KPIs that measure the company's ability to meet its long-term obligations. And the reason why this is important for you to know is that if you're preparing for a job interview as a financial analyst or any kind of finance position, or if you're an investor in the stock market, it's good to know these ratios so that you are measuring the companies that you're investing in, as well as if you're reading an article, you're able to know what you're reading. So this is the topic of this video today. And if you're new here, welcome. Thanks for stopping by. My name is Bill Hanna and I'm the financial controller. I've been in finance for the last 15 years, and I've been an auditor, a financial analyst, a controller, both at public companies and private companies as well. And this channel is all about giving you the summary or the juice of my experience. So if you're in finance or into stock investing in general, go ahead and subscribe to this channel so that you don't miss out on any of the videos that I put out weekly. And without further ado, let's jump into today's video. So the way I want to structure this video is first give a quick overview of the balance sheet like we did in the previous video. So we'll walk through the balance sheet really quickly and gain a quick understanding of the structure of it, and then use that to jump into the three solvency ratios that we are covering today, which is debt to equity ratio, interest coverage ratio, and solvency ratio. And for each of these financial metrics, we'll go through the formula, the calculation, or where we got the numbers from the financial statements, and then we interpret the results. And this probably is the most important part, is like how to interpret the result. For example, if you get a debt to equity ratio of 3.5, what does that mean? Is that good or bad? Is it better to be higher or lower? This kind of thing. I think this is the most important part. So first, let's give a quick overview of the balance sheet. So looking at the balance sheet, and obviously as the name implies, a balance. So the balance here is that we are balancing between the assets. So on one side we have assets, and then on the other side we have liabilities and shareholders' equity. And the idea is that total assets, which is in this case 450,000, will always equal the other side, which is liabilities plus shareholders' equity, which is also 450,000. And that's basically the main accounting equation, which is, let's write it out here, assets equals liabilities plus equity. And this is what we just said here. Assets equals liabilities plus shareholders' equity. Basically, if you flip this formula and bring the equity on this side, this basic math, you say equity equals assets minus liabilities, which is saying basically that your equity in the company is taking the assets and paying off all the liabilities, which is the same concept if you own a home. So if you own a home, basically what's your equity in the home? It's taking the value of the home and subtracting out the loan value, or what you owe in the home. That's your equity. Same thing here in the company. In a company also, your equity equals assets minus liabilities. So that's the main accounting equation, and we can now use that to jump into the three financial ratios. The first solvency ratio we're looking at today is debt to equity ratio, which measures the reliance of the company on debt to raise capital versus equity. Because the two ways for the company to raise capital will be, one, either debt, or two, equity or selling stock. So basically, the higher this number or ratio here, which is in this case 3.5, it indicates that the company relies heavily on raising capital through debt. So basically, the formula for that is total liabilities divided by equity. Total liabilities here from the balance sheet is 350,000 divided by equity, which is right here, shareholders' equity 100,000. So that gives us 3.5. And basically, the higher that number, as we said, it indicates the company relies more on debt than equity to raise capital. It's not all that bad usually. If it's the higher the number, it indicates that the higher the debt. But sometimes you want to take advantage of lower interest rate. So it doesn't necessarily mean bad. You have to take it with the context of what's going on within the company. If they're taking advantage of low interest rates, for example, so they rely more on debt than equity. It all depends on the cost of capital. Is it cheaper to pay interest and raise debt, or is it cheaper to issue stock and get the capital that way? So that's the debt to equity ratio in this case is 3.5. The next solvency ratio we're looking at is interest coverage ratio, which measures how many times the company can cover its interest expense from its earnings. So the formula here is EBIT, or earning before interest and tax. That's the acronym EBIT, divided by interest. And basically, when we look at it in this case here, EBIT for this company is 460,000 divided by the interest expense in the same period, which is 50,000, which gives us a ratio of 9.2, which indicates that the company has 9 times the amount of interest in earnings. So that's usually the higher the better. You want that number to be high, so that indicates that the company can cover its interest expense 9 times over, which means that they have excess funds to cover beyond the interest. So basically here it's 9.2, and that's the interest coverage ratio. The third and final ratio that we're covering today for solvency is referred to as the solvency ratio, and that basically measures the company's ability to meet its long-term obligation using its free cash flow. And you'll see that in the formula, because the formula for it goes net income plus depreciation, which basically refers to cash flow. If you take net income and add back depreciation, since depreciation is a non-cash expense, there's no cash going out when you have a depreciation expense. So you add that back, which basically is free cash flow divided by total liabilities, which in this case, net income plus depreciation is 420,000 divided by total liabilities from the balance sheet here, 350,000. You get a multiple of 1.2. And obviously, you want that number to be as high as possible. The higher it is, it indicates that the company is more solvent. It has free cash flow to cover the long-term obligations multiple times. In this case, it's 1.2. It's not all that bad. And obviously, if it goes below 1, it means that the company doesn't have enough free cash flow to cover its long-term obligations. And that's the third ratio, or the solvency ratio. So this is it for today's video. These are the major solvency ratios, or the financial ratios that measure the company's ability to meet its long-term obligations. If you liked it, go ahead and hit that like button. And if you haven't subscribed already, go ahead and subscribe to the channel. That will help me grow the channel. And if you know someone in your network that will benefit from learning about the balance sheet and the 3 solvency ratios, please go ahead and share it with them. That would help me as well. And I'll see you in the next video.